Good afternoon. December the 15th, we're coming to you from the trading bunker, having to survive the Fed day. It actually went pretty well to plan, uh, technically, and what we were pretty well thinking. So we're going to go through the first part today. We're going to go through our usual technical aspects of the different markets, specifically the S&P, the Apple, the oil, the natural gas, and Nasdaq and Russell. Then we'll go through our views on what the Fed's doing. We also have Alex here from Markets and Mayhem, so myself and Madavi, and we will go through that. So to no further ado, Mr. Powell's here to welcome us. He's handing out money again, and here we go. So there we have it. So if you recall the levels we've been talking about ad nauseum, in specifically on the S&P, to keep it simple, the whole idea of Nova Wave and a plan is we have a plan ahead of what can happen and what can't happen, right? So and hopefully you guys are getting that. Part of why we started the podcast and even the Traders Community website was to try and do that. So ad nauseum, we go on about this daily tanking. Why? Because that's been in control for a long time when used in unison with other things. So we had that correction right into it yesterday in 3 waves. We then actually tested it again today, but we didn't even have the power to get through it, if you notice it. Most of us today, we took profit on that short we had yesterday and stayed idle unless they were core positions, which we'll talk about a bit in a minute, before it. So you can see what happened. Remember the possibility we were talking about and fractals. Let's drop down to hourly. And you can see I've kept it along just to show the impact. What did we do? We couldn't go lower, right? Remember our rules? So we have ABC. Now, there is still you don't think it's all just going to go straight vertical. This can still be an ABC correcting all this, okay? So let's not get ahead of ourselves. Why do I say that? The pattern. Look where we closed at today, guys and girls. Right at the top of this channel.
Right.
Right? So we couldn't get over it. Above it, we're very close to all-time highs, right? I mean, I kind of made a joke on that. I think I got on Twitter or something. And hey, we're only 50. But in reality, that's true because a lot of the hedging models and the optionality that people put on to protect their bonus, they're probably thinking, that won't happen. And then 5 minutes, if you want to, we go through what actually happened on that number. You coming up there, sir? There we go. So there's our release right there, right? And look what we had. You had most of us sort of scalpers, they buy that reaction and they sell the reaction. That was that move. And then you had a clinical buy. Either here, if you're aggressive, or at new highs. You could see what went on there. Bit of to and fro. There's probably a lot of market makers cleaning out their option books. Because remember, when you buy here, you're making someone short and vice versa, right? So a lot of this is market makers trying to get their position back, okay? And then we had a nice move in Elliott terms, 1, 2, 3, 4, 5, okay? And that can be a B flat too. Remember, a B flat in power can go under the previous. And look that's all that work we just looked at on the top of the channel. So that was a good day. That's how we reacted to that. All clinical. You know what we were doing there. I'm going to bring Alex and Madavi on here. I'll bring Madavi on first, given he is kind of the main guy when it comes to Nasdaq trading. So here is today. It's a 30-minute chart. It should be. Yep. Here's today, early morning, overnight. We had a go, same as the spoos. We couldn't go lower. See, very close, but couldn't go lower. And here's Fed. Do you want to talk us through that? Actually, before you jump on, I just noticed this is totally green. The spoos at least gave you a little red bar here. This is totally green. Okay, go ahead. Sorry, mate.
You want me to go or you, Alex?
Either Madhav, if you want to go first.
Okay. Basically, they've been doing what they normally been doing. They're running up the perfection stocks, we'll call it, like the Apples, Microsoft, and everything. That's why you've seen such a big run in the NQs that was sold off the other day. And it was just what's been happening: sell the trash and keep the goods, And we repeated that today. And we kind of knew what Powell was going to say. And so everything worked out like we thought it would.
Yeah, it was kind of one of those. It's nice when it all comes together.
Yeah.
And then actually, I was going to get Alex to talk about the Russell because he's been spot on with this. He'd kind of been saying last few days what he thought would happen, and that's coming to fruition. So if you want to talk us through that, Alex.
Sure. So a lot of these technicals across the major indices have been trading, pretty clinically, pretty clean off some of these key levels. The Russell coming into today was no exception. While it did exaggerate, it sort of it swooned lower, taking out previous lows. Unlike what we saw in the S&P and the Nasdaq, it did test sort of bottom of this range channel that the Russell has been trading in since February. It didn't quite get to the bottom of the channel, but it kind of plunged within that consolidation congestion zone at the bottom.
Do you want me to put a more longer term chart up?
Yeah, I think that would be good, just so we can kind of give people a sense as
daily
to
or maybe a weekly.
Yeah. So you could see on the weekly chart there all those wicks down to the bottom of this range. Today being no exception, and we were able to manage to stay above the cloud, which was pretty constructive considering the Russell had a failed breakout. It really kind of humbled from there, and a lot of people were talking about this might be the end of the small cap rally, the or at least the idea that it's going to happen, that it's going to really break out. But really what happened is we just had an exaggerated upward move, and we had a sort of emotional downward move right back to test the lower end of this range. I think a lot of people with leverage got forced out of some of these names, and other people just simply gave up, and it's also a kind of a favorite index to short. So you look at the ETF, it's got about 37% of its units shorted. It was hard to find availability of shares at multiple brokers. Some didn't have any available to borrow for the IWM ETF, and we were coming into that technical area of support, and put call ratio was a little extended on the sort of bearish side, and there was a lot of skew, a lot of premium paid for puts. So what I was looking at was a similar setup to Jackson Hole. All those factors were involved there as well. And if the Fed, wasn't perceived as overly hawkish, that we could get a nice little pop. And so that's what I was trading in the Russell today. And my target was just around 2,200 or under, because that seems to be an area where there's a pretty significant amount of supply. I mean, we can't see market profile on the chart, but if you look at that, you'll probably see overhead, there's a fair amount of supply around that level. It's been a pretty key area of resistance. And it eventually
in another chart, but just on this one, this is why Uncle Andrew doesn't trade the Russell. Look at those wicks.
Yes. Yeah. So if you don't like the character, the sort of volatility of the Russell, and there are times where I don't like it at all, it can be a hard thing to trade. On the other side of it, however, those wicks are opportunity, because if you look at the zone that they're coming into, it's a pretty predictable zone of appetite for buying small caps, especially what we see if you look at the IWO versus IWN, is that there's been more appetite for value small caps than growth small caps throughout 2021, which is the opposite of the large cap side, where you see growth favored in large caps and value kind of faded. So it's been an interesting dichotomy, but today's trade was just an idea of taking advantage of the fear selling. As I think that there was a lot of people are just thinking the Fed was going to come out, markets were going to tumble and retest some of their November lows and December lows, and they didn't. Instead, I think that we got a nice relief rally because of people taking off hedges, short covering, and some risk on mentality. And we saw some improvement underneath the surface as to the level of participation in the upside, as well as selling a put premium and buying of call premium in the Russell and the other indices. So. We could have some continuation here, but we got to see
market profile for you for the Russell.
Okay, perfect. So we could see. Oh, sorry. Go ahead, mate.
No, I was going to say. Yes. I was asking you to see it. Okay, so there you go. Go ahead.
Yeah, so you see a little bit of supply up there. It's nothing incredibly huge, but it's enough to be concerned about. And it has been an area of resistance that can become support when the Russell is sort of starting to look more bullish. But basically, the Russell's just been trading between just above like 2,300 and just below or around 2,100 since February. And it got a little break above 2,400 for like a minute. And a lot of people faded the heck out of that because they thought, this was a false breakout. I heard some of the more sophisticated traders I talked to kind of that peace of mind, like, okay, this is extended. We're going to short this. We have, ability to get stopped out just above, but we feel like this is an impulse move, a weak high, and a lot of those people were very right to their credit, and so we came right back to the lower end of that range. And to me, that's always been an opportunity to buy with low risk, because look, you could just set your stop at the lows of the year for the Russell or just above that, and you get out without too much risk. And if you're able to capture that upward move, indeed, if there's a sentiment reversal like we saw today, you get out, you're able to make some profit and cash out, pocketing something like 50, 60, 70 points.
Actually, just back on the market profile. So I think most of us have a good understanding of the basics of market profile. So I won't go into it too much. But what I want you to notice is today's market profile move engulfed all of yesterday's. So think what that actually means. It means all of the, failed supply. In other words, people just giving up. That's it. Got taken. We then recovered. Formed today's POC is going to be right here, whatever that is, 62.
162.
And then we took out all of this failed. We didn't take that one, but we took all of yesterday's. And I think what yesterday was, it was very heavy selling. So we actually got through all that. Last time in this little period, 1, 2, 3, 4, 5. How many days we got here? 1, 2, 3, 12 days it looks like. Look what happened last time we had one of these all engulfing. See what happened there? I know that was a thinner market. It's probably we can actually look what it was. The 5th, so that's the start of the month, right? Probably Omicron and all that. But look what happened. So it forces people to either cover or they get really bullish. This is a small cap index. So there's a lot of stocks that are good in here. Just because they're in it doesn't mean they're bad companies. They just got smaller capitalization, but there's also a ton of trash, right? Well, this kind of tells us they've taken out the trash.
And one thing that's worth noting with the Russell, a lot of people like to bag on it because, AMC or GME or other sort of meme stocks kind of rotate as the top holding. But I think one thing that yeah. But and it's look, I mean, I understand it, but at the same time, we got to be honest with ourselves. That's like less than 100 basis points of weighting. So they're in there.
I'm kind of joking, but
right.
It's got a lot of the tax guys, the ones we sell for tax, happen to be in that one, but they are influenced by that.
Especially this year, where the small caps really didn't have a very good year.
I think I put in the wrong. Yeah, of course I did. So if you look at and I looked at this just before I brought it up, look at the difference here. So remember what we saw in the other one? Nice and steady. This is the spurs.
Yeah.
But it didn't go. So remember, we were way down here. All that action down here. Got filled in all that supply, which was from over here on the Russell. And look where we closed, right? Now, remember your POC rules. If this becomes untouched or a virgin, call that a virgin POC tomorrow, you can get a significant rally going. That's one of the rules of how we use POC and Novawave anyway. I know that's not some of the people out of the Merrill School, but that's something to watch. That's if it starts running away, right?
Right.
They usually do it in 1 to 2, 3 days. It's kind of like the runaway gap rules. So we covered those pretty well. Apple was like just this stock for mine even trades better than the S&P technically. It's very clinical. It's very deep. That's why. Matt, I mean, you can get $20,000 shares quoted to you 5 cents apart. It's the volume's there for 1,000 at a time on options. It's deep, which is what you want if you're a good trader with discipline and recognize those flows. So we came down perfect yesterday. We actually broke back up and came down to test. There's the Federal Reserve, and that's what happened there. So we had a powerful move. That's your 60 minutes. And all this, remember, was testing that 7/8 to 8/8 area in here. The 7/8 is relevant because of that fractal up there. That's for another time how that works. But look what we got. We recaptured that cloud. Remember, the twist was there. Lots of bullish things. But again, don't get carried away with it. You've got to be disciplined. This can be an ABC that we saw on the other indexes. 4 hour. Look where it stopped at. Pretty crazy how this stuff works, right? Just maths, right? People are unpredictable in a predictable way. Or as I said to Craig the other day, predictable in a predictable way. But look at that vertical bar. That's almost the same as we saw in Nasdaq. Oh, that's a surprise. Apple's 11% of the Nasdaq. And Madavi mentioned that, right? Right at the start, what ran the Nasdaq. So clinical stuff. We will have a quick look at oil, and then we got a lot to talk about with Fed and stuff. Remember, we've been talking about this probably being an ABC off that tanking. So that's shaping up. We got this Cajun above it. Now we've gone side to where we open up the new cloud. So that's got lots of energy if it can get going. Again, don't preempt that, oh, it's already there. You got to be disciplined. Here's your natty. Guess what? Bloody nothing. Again. So it's embarrassing sometimes to say you trade natty this time of the year. But well, that's for us old school guys. That we have those 4 or 5 times a year where it's good. And here is the hourly, and you can see what oil did today. Yeah, that's the one Apple natty chart we're going to look at. Sorry there, bud. And look at it, busted that very simple downtrend. So these things work. Downtrends work very well on liquid product. And if it's a false break, like a spit, you know that there's no follow through. So it's even more significant. And then there's, of course, the spit of a spit, which is really powerful. But look what that did. Real classic tanking. And you had your 8/8 it's spinning around. We got through that cloud, it accelerated. And this was just under the cloud. So remember to use all these things together. Don't be confused with just getting one. So that's pretty well all we want to look at technically, I think. Did I miss anything, guys? Oh, I guess we should look at Bitcoin for Johnny. That's a, what time limit is that? 240. So let's look at it short and see what Bitcoin reacted. So Bitcoin, so when was about here? So Bitcoin did go up with Powell. So there's a lot of people just trade Bitcoin now instead of trading the other things. I would read it more as that. I noticed people on Twitter knocking Jerome Powell for not understanding crypto well. Why should he? Would be my first comment on that. And do we all understand it, right? But, of course, the people saying or making all those accusations know everything about everything. So I'll leave that as that. Was that cryptic? Perhaps. Okay.
Cryptic on crypto.
Yeah, but seriously, I don't want my conservative banker to be worried too much about the most speculative actor of it. I want him to at least guide us, So here we are. I know this guy today would have been doing a bit of this. So let's start off with Alex. Got a lot of interesting stuff today about it. So so this is Paul Volcker for those who don't know.
A legend.
Which would have had a different this is kind of how we thought he would be reacting today to today's Fed meeting and the carry on. I can't get him bigger, unfortunately, but so no further ado, Alex, if you want to your comments on what we saw today with Jerome Powell and the market and anything different to the unexpected. It was all pretty much as expected, and all that website stuff, is on the website. Everything how it changed, market's reaction, and what was actually said. So, without further ado.
Yeah, so I think we had this covered. Both of us had reached a consensus view that is what ended up playing out, and it was the Fed came in and basically doubled the size of the taper to start in January for that acceleration. They signaled there'd be 2 to 3 rate hikes in 2022 and potentially 2 to 3 in 2023. But they also said that they would be sensitive to a slowdown in the economy, and that may affect the schedule of their tightening process, in particular with regards to rate hikes. They did mention they discussed quantitative tightening, but they didn't provide any guidance as to what that would mean, other than some sort of vague conditional ideas that maybe they would do that before they hike rates, but certainly that they want to finish their taper process before they get into the rate hiking cycle. Powell also signified that he was disappointed with the labor force participation rate not improving and not providing more sort of equality across the opportunity spectrum, but did signal that unemployment had made improvements in the rate along with the rise in inflation that led them to believe, with the strong economy that they feel we have, that it was appropriate to hasten the pace of sort of post-COVID normalization, right? So I think we can reasonably conclude that with how large the amount of global debt that there is out there and how much of it is rate sensitive, that normalization in this era probably means a ceiling for the Fed funds rate of maybe 2%, maybe 2.5%. Although I think once they get into the rate hiking process, they're going to start to find that a lot of these leveraged entities, whether they're sovereigns or corporates or households, may start to have some more tumultuous financial outcomes, especially in the more fragile side of it. And in fact, Scott Meinard of Guggenheim Investments was on Bloomberg after the rate decision and before the presser, speaking to this. I've been following him for a while. He's very adept at analyzing these bond markets and macro views, and so I think that he's definitely onto something. He's forecasting a potential recession end of 2022 to early 2023, which actually is interesting because I've had a similar view before I heard that interview from him today with regards to timing of it. And so that's one reason I think also that we're seeing not just the Fed, but other central banks around the world starting to shore up monetary ammunition. They need policy tools ahead of the next recession, which is probably not too far off, because my view, and I think you agree with me, mate, and I think Madavi, you agree as well, is that this cycle actually started in 2009. And while there's been some hiccups along the way, we're still in that same secular bull market. And so it is a pretty long credit cycle that we've been in. And it's probably closer to its conclusion. So, overall, the idea, the takeaway from the Fed today was they came in within the consensus level of hawkishness. So it wasn't really a hawkish event. And with the event volatility behind us, we saw a relief rally in the market as it looked like people were taking off their puts. They're selling premium. And it looked like people were getting back into risk, and there was some short covering, and the convergence of those, as well as having the event volatility behind us and the market now focused on rates rather than tapering, seems to have kind of changed the outlook a little bit on risk. And so we saw a pretty nice risk-on environment, although I would caution anyone listening, if you're shorter-term horizon on this, don't necessarily assume that because this happened that we're in the all clear, because it can take a couple days for the market to fully digest the implications of the Fed's policy and analyze how it might change positioning. So I would say this was an encouraging development for people who are bullish on this market, but it doesn't mean we're necessarily out of the woods, and we're already grinding into some pretty key resistance areas to watch.
Yeah, some good points there. And I think, Madavi, do you got anything to jump in on there? What you're saying?
Basically, they're getting, if you're not a perfect value stock, you're probably going to get cut. There were some stocks you see that were high flyers that were getting hit. So be careful if you're holding any of those high flying meme stocks. They're probably if they're not set up for perfection, they're probably going to cut it.
Yeah, we saw, who was that stock today? Roblox, right? So
yeah.
Roblox missed a metric. What was it? A monthly metric, Alex? And $10 like that, and that's before the Fed. So,
Yeah, that was so they missed the sort of amount of user growth that was expected, and apparently they put out these metrics periodically just to kind of keep people posted as to how things are going at the company, which is great transparency. But the problem is that as soon as investors have that information, they're immediately discounting their next earnings. And so if this trend doesn't improve, the multiple compression we're seeing in Roblox as growth is being discounted could continue.
Yeah, 100%. And actually, I have kind of some different views, I guess, to most on some of this, but the three of us have a similar view as far as the stock market goes and the central bankers go, particularly our own. The US. You could argue this all started way back with long-term capital, which was Greenspan, but definitely since 7, 8, 9, it's been a band-aid. Put your finger in your mouth and put it in the air. See where the wind's blowing. How do we fix this? Constant. So I don't, and so it's probably why I'm not in the conspiracy camp of all this, which upsets some people in the financial space. But I really don't think the banking elite, the academia, the politicians are the sharpest knives in the drawer, and they all drink at the same bar, so to speak, and they don't really know what they're doing, would be the nicest way I could put it. I actually have more faith in Powell than most of these bankers, because at least he comes from uh, a more real world in the sense of understanding people, how business works. If you look into his background, I know he's always pulls a lawyer, but he's been around the Carlyles and all this sort of thing. I'm not saying he's a genius or anything, but Alex made a good point today. At least he tries to answer the questions. I think these guys are in difficult situations, and that's why we put up Paul Volcker there early, and so Paul Volcker would be shaking his head. Obviously, he'd be putting interest rates up at 20%, etc., etc. But the big difference is here: we've come from 2008. We still hadn't got out of the woods. Then we had the coronavirus collapse of everything, right? Locking down the world, and we don't want to get an argument about all that. But the bottom line is they did lock down the world. They destroyed a lot of lives. A lot of people have never recovered, right? And that's another. We really live in two worlds. There's people that have no concept that there's people still out there destroyed.
Lost everything. That's actually something that deserves, like, maybe it's even its own kind of conversation, just a sidebar, because there's a lot of kind of unaccounted for lack of a better word, sort of slack that has been created in especially the bottom 60% of the population, where there's a lot of small businesses that have closed and have never reopened. There's a lot of families whose life savings and nest eggs were completely depleted, and they may even be eye-hole deep in debt now. And that's going to create some drag effects. There's also some, there's some of these things that were in forbearance are starting to come back online or are already online. I think student debt comes online in February, where people are expected to start paying it back. There's been mortgage forbearances, other kinds of debt forbearances that have either come online or are set to come back online. So there's a lot of drag that's coming into play in 2022 that I think is going to expose the unevenness of this recovery. And I'm not saying it's not a recovery, because I mean, by any kind of definition, we've seen economic growth. We're out of a recession. We're seeing improvement. But to consider it a success and mission accomplished, I think that a lot of these areas of uneven recovery will be further exacerbated and more visible, especially as we get into the back half of 2022 and early 2023, when the slowdown in the economy that's likely to happen manifests, and we start to see the tide come out, and we start to see how many people are really not doing well, and how many businesses are really leveraged and can't deal with a more normalized rate environment and less liquidity.
Yeah, I mean, it's there's definitely that, and sometimes it's aggravating because if you're a trader or whatever, you get lumped in that brush with that ilk, right? But definitely there's been a big change. And I just wanted to show off my intern pulled out her favorite shirt today.
Oh my gosh!
So yes, that will be available on the as merch in time. But yeah, she pulled that out at precisely 2:01. Well, she's been modelling it. I won't say what she had on before. But anyway, all jokes aside, that's kind of what goes on in these kind of markets. But the other thing, so we could talk all day about that, and I think it's an important thing everyone should address. And the ignorance, and that's why a lot of people get caught on these bull markets, right? They think everything's good because they don't live in that world. Certainly, most bankers don't live in that world, definitely not politicians. And I always laugh at partisan politics. If you really think that if you're a Trump fan, that Donald Trump's think it's all he's saying about you. If you're a Joe Biden fan and it's all he's saying about you, then do yourself a favor.
Yeah.
And it's pretty well what you got. So you got to be in control of what's really going on. And secondly, as far as bull and bear markets go, my theory is whether, and I don't think this was really intentional, but you heard both Alex and Madavi point out over the last number of days in particular, but it was self-evident today that this market, as judged by the S&P, the NDX, and the Dow Jones, are controlled by 5 or 6 stocks. You can add a few onto it, but pretty much it's those. So that is your move. Outside of that, I think there's been a lot of bear markets by different definitions in particular sectors, and they're destructive, and that's what a bear market is. It's like a massive rinse. Now, some of it's purely because of valuation. Things went up way too high, and the one thing the COVID shutdown did was it forced positively the fastest technological advancement since probably the Industrial Revolution, really, or something like that.
It really did.
Or one of the wars, right? So that revalued stocks, it revalued jobs, and that comes back to where a lot of people just aren't trained for jobs, or their small business was destroyed. They cannot get loans. It's not a question of them. So it's bad what's out there. Homelessness is rife. In somewhere like California, it's insane. There's millions of people living on the streets in the United States at all-time highs. And I'm not getting on any political thing. That's reality. And that's what overhangs this market. So the question is, with those mini bear markets that have been going on for a while in different sectors, real estate, we had our own in oil and gas. Trust me, I'm from Texas. Might talk a little bit different. I've changed my accent. All jokes aside, but we went through that, and we know how decimating that was. But then you recover in different sectors, and so a lot of these stocks resemble that. So I guess the basic question to the answer all that, are these other sectors going to come good again, or are they being replaced? You can look at some of these ARC things. So a lot of it's cultish. So in other words, do they catch up to the Apples? Who are the other ones? Apple, Microsoft, Google, that are in that Sweet Six or something like that, right? Or do those all come down? And that's pretty well the answer to everything. If you know the answer, I think let us all know. But it's kind of you can't compare this, in my opinion, to any other time in history. We've got the QE, right, has distorted everything. It's sped all these recoveries up. And we've got, at best, incompetent, inept leadership right around the world. In other words, what the heck do we do? We've had political manipulation like never like this in any time in history in our lifetimes. Right? You've had all that is distorting, and I'm just talking about how it distorts manipulation in markets and etc. So it's hard to value it. And at the same time, when people say, this time's different, it's never different. People are very predictable. And greed and fear run all these. What's different is the way we measure markets. There's more people involved than ever. People push back against a lot of things. So we're getting these very quick moves. Remember, 2 weeks ago, it was another end of the world. Was it 2 or 3 weeks ago? So right around Thanksgiving.
It was Thanksgiving.
Yeah. It's the end of the world. Markets collapsed. The new virus is going to crush us all. That was all very much done around a very thin time. Thanksgiving, no one's everyone's around. But the difference was this time, whether it was intention or not, the people didn't react with the fear that was expected by many, right? Sadly, a lot of people use times like this to profit out of other people's fear or weakness, however you want to put it.
Yeah.
So that's an involvement. So these things are constantly evolving, the way everything reacts, you know, and that filters through markets.
Well,
Definitely does, you know.
Andrew, this is what's different too. You know, in this type of market, we got a lot of triple stocks. We got a lot of AI systems and stuff, along with a lot of online presentation, right? So that's why you see these over-exaggeration of these moves also.
Right,
You know,
100%. And we're talking about that too, that on the Nasdaq in particular, you have those triple vehicles, which from a trading point of view and the AIs and the algos, I like people that knock them, they're generally because they got the wrong position on. But let's be honest, this market wouldn't be here if it wasn't for those things. It's kind of saved the market, and it's brought a lot of people in. Things are happening a lot faster than what they ever have before. And if you're a technical trader, the reason Nova Wave works, it's all mathematics. Guess what? Most algorithms, they're all mathematics other than pure news algorithms. And what I mean by that is they pick up a headline and they sell or buy on it. So everything's cleaner and faster. And if it's wrong, these systems find it out a lot faster than ever. So you find out on some of these short squeezes or long squeezes, if it's a BS one, like a fraudulent sort of backbone to it, the markets find it out faster than ever. So there are positive, very, very powerful positives from a lot of this sort of thing that goes on. And if you notice the real fraudulent bit of it, SPACs and all this being overvalued, well, they've been found wanting very, very powerfully. I mean, some of these things are worth nothing now, right? So the market finds it out quicker. And I actually love the fact that the little guy has a chance with the Robin Hoods and all that. I can't stand Robin Hood. What they did was despicable, bailing out those GME guys. And that's for a whole podcast in itself. And guess what? The market just took them to town. They were $17 or something today. But I like the fact that their intentions before all that, before they got really big, was to give the little guy a go. But do they get a real go? The rules on pattern day trading in America really do just favor the wealthy. Let's not kid ourselves, right? But at least everyone at some level has a chance. And I kind of laugh when this market kept going up, right? And the season, this has got to go down. This is BS. But, you know, they make fun of the pajama trader and all that. But a lot of these guys learn quicker, and they've learned in this world, the algorithm world, and that's why they do so well on crypto and all this sort of thing. Where people like us are like, to be honest, because we've come up from a more conservative constraint, it doesn't suit us, right, on many levels. So, you know, you can knock us with Jerome Powell if you want, I guess. Not to say we're oblivious to it. That's not what I'm saying. But anyway, we did get off in a little bit of a tangent there. But that's kind of what I see in the markets, is different markets. And don't forget they manipulate these indexes. But not necessarily is it intentional, probably, but maybe not. But they will take stocks out of the indexes that aren't performing. You know, the Dow, the S&P, whatever. So the indexes are different stocks over time. Even the Dow last year, they took out Exxon and who else did they take out? Was it Pfizer or someone like that? Someone big, drug company. We had Tesla get put into the S&P and the Nasdaq, right? So a lot of people take that as that was just a pure pump prime. For whatever reason, we know it. These things are constantly evolving, and that's all part of the world, the new world we live in, and that's reality. We are constantly evolving, right? Theoretically, I don't think intellectually we don't seem to be. If you look what's going on in the world.
One thing that we don't know is how bad is the next dump is going to be. We had basically a super rally. Now usually it reflects on the downside.
Right. And in the bigger picture, at what point does this constant manipulation and changing and mini bear markets. Is this the last one, for example, if my theory is right? Or is there going to be something else grabs hard? We really don't know, and that's why I use technicals and I limit what I trade in for that reason.
I'd love to prognosticate a little bit on a macro kind of monetary subject matter basis. I mean, I feel like this cycle, like the tail end of this cycle, this is a really bizarre, unique period in financial history, because I don't think there's ever been any period that, at least where I've been alive, and maybe not ever in human history, where we've met a credit crisis with just a wall of liquidity. I mean, the last time that, and I mean also in a very short, compressed time scale. Like when we had the great financial crisis, it was sort of one stick save after the next, with rate cuts and certain kinds of accommodations, setting up special facilities for distressed debt, TARP, all that kind of stuff. But what really turned it around was the combination of QE and FASB suspending mark to market, so that banks had a sort of mark to make believe for all their exposure to mortgage-backed securities and other illiquid assets that were presumably worth nothing. And that allowed a sort of phantom reliquification, because you could say all the stuff that was worth nothing, that you couldn't get any counterparty to buy, it was worth something. And then, the Fed came along with their superhero cape and was able to buy it for much more than it was, likely worth if there was any market for it. So, this time around, instead of that gradual approach to the crescendo, and then it was like from late 2007 all the way to early 2009 that policy was ever increasingly aggressive. Here, we had the exact opposite. COVID happened. It was a different situation. It was very fast shutdown of the entire economy. It was already a period of time where the economy was somewhat vulnerable. Late 2019, we saw some signs of stress from the Fed's attempt to normalize their policies. And so it was kind of the perfect storm. And the central banks around the world said, look, we can't afford to wait. So what we're going to do is we're going to cut rates to zero and just flood the system with liquidity and promises of backstops. And so in doing so, one of the after effects that something like that has, in my opinion, is it compresses the duration of that kind of wherever you are in the cycle, right? So we're kind of late cycle, but it reset us in some ways to like have a sort of mini credit cycle within a larger cycle. So we had a lot of these early cycle opportunities, these longer duration risk assets really benefit. But that wall of liquidity, the velocity of it started to run off in early 2021. And so by March to May, the velocity of liquidity had tapered, to borrow a term from central banks, so significantly that you saw also some of these higher risk, high beta rate sensitive assets get sold down at the same time, because that wall of liquidity was like a rising tide that lifted all boats. And as the velocity of it began to dissipate, you saw SPACs, you saw, small to mid cap growth, you saw other more speculative long duration assets really get sold down and never recover. And so that's one of the reasons that I think that this cycle is a little different, because we had this wall of liquidity, the velocities run off, now the liquidity is being drained. And so, yeah, I think, the cycle ends probably late 2022, early 2023. And sadly, I'm not sure if we have much other possibility than a pretty prolific bear market and a pretty nasty recession, just because there's so much excess of debt and leverage to work through across households, a lot of corporate balance sheets, and a lot of sovereigns. So it could be a bit of a bumpy ride ahead.
Yeah, I mean, it's going to be interesting if, and I think one of you guys mentioned earlier that they're preparing for the next downturn.
Yes.
The one problem is, how much bullets is Fed going to have something as big as we think it might be?
Exactly.
How much chamber is going to have? And
right.
Is this cycle repaired, or people's got so much liquidity that they're going to step up? But this debt crisis, eventually is going to come and meet the road. Who knows when that'll be?
Yeah, the rubber meets the road. And it's interesting comparing it to Japan, with the Bank of Japan, because they've been trying to do this for eons, right? And still
they want inflation.
So was it last night the BOJ governor said, "Oh, yeah, we'll get to 2%," and that's literally right after the US had back-to-back, record CPIs and PPIs. Like we're about to hit 10%, right, annually on PPI.
Yeah.
So what these bankers aren't learning, they live in such a little I mean, they got just total blinkers on that. What can go wrong? I mean, it was only 2 months ago, if that, that
I
they were
think
saying everything's transitory, and they say it all the same. They drink from the same bar. Like, Bank of
Yeah.
England guy will say it, and then the what's the lady over there in ECB?
Lagarde?
Yeah, Lagarde. I mean, that's all
Andrew,
you need to know about bankers. Who's
hey,
running it,
Andrew,
really?
put yourself in their shoes. You got this ticking time bomb ticking that you did not create. So you got to make the best of the situation.
Oh,
So
100%. That's why I mimicked that conversation with
yeah,
Powell and Volcker. I mean, and that's why you can't. It's fine. I find it like it's easy to criticize these guys or whack out a
but
conspiracy theory, but let's be real and put them in. Imagine what's going on, and you've got. I mean, it's a mess. The politics in the US, right? I mean, we've been promised since January, February that we were going to have this massive infrastructure bill. Here we are at Christmas. We're having debt limit things every other day. I mean, imagine being the central banker with that around you and all the other problems. But, as you said, what else can they do?
you got to take it and look at the big scope, small scope, and make as much money as you can because that's what's going to be able to
Be
save
self-sustaining.
you no matter what happens.
And so, just for the central bank fans, we got Bank of England and ECB coming up too. So now the Bank of England one's an interesting one because the previous, not the one before tomorrow's meeting, it was expected to raise. They didn't raise. So don't forget the expectations. A lot of them are put out by the media or bankers because that's what they want. They want their position, and they didn't because and this was before the new variant because COVID's just such a big problem over there with the NHS and all that. England's a bit of a mess with their health system. And then we're coming in a winter, etc., etc. So it's going to be interesting what they do tomorrow in England.
Yeah.
Um,
No, absolutely.
and so those can affect our markets if it's a shock either way, and the FTSE goes way up or down, or the DAX or the stocks over there. That can affect us. Can affect our markets for sure. But that's a good discussion there. Basically, the bottom line is a lot of it's a guess. We're trying to think what these guys are thinking. I'm certainly. I think that's why I really stick very much technical and look at the overall crowd behavior. I look at because markets are a reflection of the herd, or Gann would say the harmony of the markets, right? And it gets out of whack. That's why we use Murray math, which is basically Gann and things like that. Try to work out the crowd behavior, because as traders, it's how you react to the market, because the market's always right? So whether Powell's right or wrong, it's how the market perceives he's right or wrong. It matters if you're a trader, and I don't even, I see people projecting on 2022. After the last 2 years, I think anything can happen and expect the unexpected, What we do know is they're trying to get prepared for something bad to happen. If it doesn't happen, all well and good, but at least they're preparing,
And I think that, when we're longer term investors, it can behoove us to prognosticate, but doing so conditionally. If X happens, then consider Y. And so a lot of these scenarios that we're looking at for 2022, it's like, okay, if the economy slows down, then I might adjust my portfolio this way. If the Fed changes their policy framework in this way, then I might adjust my investment thesis in this manner. So it's all sort of conditional, right? We can never have a crystal ball. We never know what's going to happen the next day, the next week, the next month, the next year. But we can at least kind of come up with ideas of, okay, but if this happens, then we might be able to take this action to react to it. And then when we have that plan, it's just like a daily trading plan. Like if I get into S&P futures and I want to trade it, I'm going to be looking at both. Okay, what's the bull case? What's the bear case on just a technical basis? So that if it flips to reverse and I was bullish and then it becomes a bearish pattern, I might flip my position in reverse and start shorting from there. And having that plan in your mind before you're trading or in the longer time scale investing makes it a lot easier to adapt to a changing environment. whatever the time scale may be.
Right, and that the main, as I said right at the top of this podcast, the main reason that motivated us to actually become, I guess, out of our little world, is to explain what we see and having a plan, longer term, short term, and just pass on that knowledge. But it's so important, though. You just never know, you know.
Here's one thing to keep in mind. As much as the Fed says they're going to raise interest rates and they'll take it back to normal levels, I heard one of the guys talking about it, that the Fed never looks at the debt. I think they're lying to you. They can insert
right. Well, let me ask, was that person on CNBC?
Yeah, you remember us talking about that?
Right.
That never looks at the how much interest they got to pay.
Yeah, so they're next to useless on those stations, and those people never just look who they mix with. They mix with the people that have no idea of Main Street, no idea of reality. Yeah, and so they're always wrong, and pretty much and look, anyone can be right in a bull market, but just look how I just think on those type of TV shows, it's kind of like stock jockeys. They're all bearish as all hell. Then they're bullish as all heck, you know, within days. And nothing's really changed. Because their business, you know, they make fun of the Facebooks of the world. But that's all those shows are, just some form of clickbait, right? Then exactly. But we did ban them a long time ago from our trading room. For a reason.
I mean, you kind of, it gets to a point where, you know, price is driving sentiment. And while I understand that to some degree, you're not going to be successful if you're buying tops and selling bottoms, right? And that's kind of what this sets us up to do if we're defining our trading psychology based on price as sentiment. And so I think, you know, that's another thing. And mate, you made this point the other day when we were talking about just sort of trading within a day, but it applies to almost any time frame. You know, oftentimes it makes more sense to take the trade off the support level than trying to hope that the breakout continues, right? Like some of the best trades can happen when you're trading in a range. You buy the bottom of that range, you set a well-defined stops, your risk is lower than your potential reward, and you know, you can be wrong many times doing that kind of trade, but when you're right, it can make a ton of potential gains. And I think that's one of the things that, you know, if you're defining your sentiment by price, you're never going to get in that trade because when it's hitting support, oh God, we're all going to die. Like S&P 4,500, you know, after Thanksgiving. Oh, we're all going to die. We're all going to die.
Right? I love that. And it forces it. So you got the weakest thing of a human is our emotion, our ability to be manipulated. Right. And don't kid yourself that you don't. And that's why I brought up the politics thing earlier. Right. And controlling that and then recognizing your own fallibility. I won't even try.
Fallibility?
That's the word I'm looking for. is key to so much. And in reality, it's very difficult to. So that's why I'm very stringent on trying to control that. Because most of us that are good traders are kind of aggressive, type A boys or girls, and our strengths are our weaknesses, right? So that's why I like Gann and why I like Elliott. It's measuring the crowd, numerology, but you've got to look at your handbrakes, right? So that's the pure math bit, and people are predictable, and because they're herds. Like any of us that have grown up on a farm knows what sheep and cattle are like. Well, that's humans are like that, you know, and there's plenty of studies on that. Just look at and so I also believe in the theory of reflexibility. I call it. It's similar to Soros's. I forget what he calls it, but it's almost the same word. But what markets trade off markets, so then they start to feed off themselves. So buying, what I like to say, buying begets buying, selling begets selling. Oil markets go up because oil prices are going up, etc., etc. And then it gets more and more into that. Nothing really changes, yet the S&P will move 200 handles because everyone else is selling or everyone else is buying. We saw that today. Right. We saw and we're not geniuses. What we said this morning and last night in the wrap and the wake-up call this morning was exactly what happened was expected. Right, they doubled the taper. They did the same thing with the rates. Everyone expected, yet, wow, we get this monster rally, which is what Madad was saying. Now they're going to sit down and go, oh, okay, what's next? But they're going to wait to see what the market does, because they just react and react and react. So you want to be proactive, not reactive. So you want to be reactive in the sense of respecting the market. But what I mean by that is you're proactive as, okay, this is what this is doing, and understanding what that's doing. Otherwise, you're going to be buying at the top of a wave 5 or C rather than selling,
Exactly. Yes.
And so that's a hard thing. And so a lot of good traders come from that sports world just purely because of that bit. The danger of sport is then your ego gets out of control, right? So that's all exactly the same with trading. It helps to be good at maths and quick and all that, true. But what'll kill you, no matter how good you are, is if you think you're better than the market and the market's wrong. It's never bloody wrong, right?
Yeah, ego should always be avoided in trading. I mean, it's certainly, I see a lot, especially newer traders, get really excited when they make gains and get really bummed out when they take losses. They also are tempted to cut winners because they've had losers and they don't want their winner to turn into a loser, and then they hold losers because there's this hope that maybe they're going to turn around. And, the problem is that sometimes the market is going to let you recover from some of those bags, and so you're tempted to do that kind of behavior again and again, not realizing, A, the opportunity cost, you're tying up capital, and B, it's just bad behavior. Cut losers when they're small losers, and ride winners until they're not winners, and you start to come away with a situation where, as long as you're not letting your ego define your trading, that you're fully willing to accept defeat, and you're fully willing to embrace success, you're going to have a better time trading. On the other hand, if you sit there and let your psychology be defined by how hard you're winning or how much you're losing, you're not going to get that next good trade, because you're going to get so caught up in the moment that when you're really winning, you're going to put on a bad trade and blow away your wins. And when you're losing, you're not going to be as tempted to put on a good trade because you're not feeling good. So taking out that emotion, that ego from the trading process, being very systematic, like Andrew said, having a system, having a not like being reactionary, but being kind of proactive, having a plan ahead of the trade, defining your risk, knowing that it's less than the potential reward, and following that system. That's where successful trading is built off of, and you're going to have moments where you're grinding your teeth and you're like, is this the right decision? You just follow the system. The system will let you know if you're right or wrong. And if you're wrong, you get out and you go again. One of the other things that a lot of people deal with as part of the same ego and psychology is that fear of missing out. Yeah, and FOMO is going to kill and blow up more portfolios than it's going to help. There's very few people that made it by FOMOing. And if you do make it by FOMOing, watch your butt, because it's more likely that you're going to make a bad decision. Because you said, oh, FOMO worked that time, why won't I do it again? It'll work again. And then boom, there goes your account. So, just be systematic. Approach trading objectively. You're never going to be smarter than the market, but you can harvest beta, and maybe every once in a while you'll have alpha. But doesn't mean it's time to get your head all inflated and make a bad trade, right? Just stay emotionally neutral. It's the hardest thing for a lot of traders to do, but it's also the most important.
Well, I think trading in reality is one of the hard, it's not as hard as being a doctor or something. I don't want to say that. But it has so many, it brings out greed and fear. So it brings out those primal, feral even, really. But really, it's the only way to learn a lot of what we're saying is you got to have it to any good trader, big trader, successful trader who hasn't said he's lost a crap load is lying to you. Because the only way you really find out that all what we're saying, Alex just said there, is actually happened to you. So believe me, people do lose, and things like that. It's a big deal, right? Until you do it. Or experience. So it's good we're trying to help you avoid that, right? And so I don't want to say an old song, ego is not a dirty word. But it's controlling that. It's not let it overtake you, right? And it's a fine line, because you want to have that aggression and confidence, but you want to have the ability to, know when to stop or not to do something. I often say, and mean it, some of the best trades you'd never do. The best trades you do are the ones you never do. So if you don't do those trades, like for mine, I covered stuff in the morning, then I just waited till the Fed Didn't do anything in between. Free your mind, and then you can act and pounce. But you're also being mindful of, look, you think this is going to happen, like it all turned out it did, but it doesn't always. So you want to lower the risk of, oh, crap, I didn't think that was going to happen. So you want to be as in control as much as you can and give yourself as much edge as you can. And you're competing against machines and all that, but use them to your favor. Most of these machines are mathematical, right? So and when it's too dangerous to trade, guess what? Don't trade. If the instrument, the stock or the futures or the currency, whatever it is you're trading, doesn't suit your mindset, your personality, your reactions, whatever it may be, don't trade it. Because then you're not a trader, you're a gambler. And casinos make a lot of money, right?
Yeah, the house always wins.
Right, and there's a reason why they chase whales. So, anyway, great conversation, guys. I hope we helped. We got a little bit away from our normal stock trading on charts and everything. But I think it was, hopefully you enjoyed it. Anything else, Madavi, Alex?
So, we have quad witching coming up on Friday. There's a pretty big amount of gamma roll off. It could cause some volatility. There's a lot of put options that are rolling off there because there's so much hedging going into everything this month. So, assuming that the market is constructive going into that, which it seems like the probabilities favor that outcome for now. Obviously, we have to see what tomorrow brings, but it seems like the back half of this week could be continued to be somewhat constructive here. Obviously, we have some key resistance up overhead that we have to watch, like 4,700 on S&P. But my bias is overall bullish, but I'm prepared for the bearish scenario too. If we get reflected down from this resistance level, I'll just as quickly turn short. And then going into next week, we have volatility product expiration on Wednesday, and that's another driver of potential volatility in equity markets, so something to keep an eye on.
Yeah, and bear in mind, just before Madavi jumps in, I just want to remind that most people away for Christmas or thinning out. This is this is going to sound terrible, but this is the first Christmas party season you've pretty well been able to have for 2 years. So, you know how that goes. And as my sons keep saying, what am I getting for Christmas? So you got to do your Christmas shopping. But jokes aside, things like expirations, there could be opportunity with some good gamma plays. So Friday's always a big weekly expiration, and a lot of those big moves happen from them. Not saying there will, but keep your eyes open if you see those kind of volume plays coming. I do see, talking about that, AMC going up here. That's one of those things that's often exposed to it. And Apple's trading just under 180. So they're buying things up in the post-market here. But keep an eye. Hopefully it's helping walking through the way we look at charts and markets. Also, we still have 2 weeks till the end of the year, so that you still will get, I'm thinking most people have probably done it, but you probably could get some tax selling of certain stocks that you may love, but they're still getting sold off because Freddie, who made $1,000, might want to take his $800 loser, or vice versa. So that's out there too. So keep in mind of the surprises. That's kind of why I like the liquid, bigger kind of market stocks. And I guess the least ones likely to be hit by that are the ones trading around 52-week highs and stuff like that. Just everything's kind of logical in trading if you want it to be.
Yes.
So that's all from me. Madavi, anything, mate?
No, that's about it. Let's see how it goes and get ready for the new year.
Yep. And so we got Natty Gas out tomorrow. Nothing really unusual in that price, so there could be some movement there. Oil we had today. And oil traded nicely off what was a bullish number, and obviously the Federal Reserve helped that. We will take orders for that T-shirt soon. Thank you for watching. Maybe have a few surprises there. Anyway, that's it. Thank you, Alex, for joining us. Follow us on social media, our socials, and they're in the thing there. The what's the word I'm looking for? The description.
Description.
So
Yes, sir.
Traders.com and Mayhem 4 Markets with the number 4 in there. Like and subscribe. Share it if you find it useful. Comment to us. You'll find us on Twitter. Alex is a little bit more there, a little bit more than me.
Just a little bit.
And Darby pops up every now and then too. So anyway, seriously, everyone, it was a good day. I hope you enjoy it. We'll see you in the morning. Enjoy your friends, your family, and goodbye now.